Welcome back to the Market Matrix. Today we're going to speak about a candlestick pattern called the diamond bottom. So what it consists of is a stock that has a down move and then it sort of bottoms out and reverses and goes higher. So this is a bullish formation. We are anticipating, once we see it formed, a move higher. So let's check it out. Here's the downtrend that we have. Stock is trending lower. There's just a lot of selling going on. No buying really happening over here. We have these little wicks, but no buying enough to stop the price from going down or make it go up. Up until we see over here that, okay, buyers are starting to step in. Let's see what's happening. Is this just a minor pullback before a continuation lower? Or is it some buying pressure that's going to stick around and maybe even more buying pressure steps in? So at this point, we don't know anything except for this comes from a down move. And there was a little bit of buying over here. So let's see what happens. The stock trends even lower. And then it starts bouncing up a little bit. Goes a little higher. It broke this high over here. So we know, okay, buyers are still here. They managed to step in and buy it over here. Up until it sent over here. Sellers came in sending it lower, but wait, buyers still coming in sending it higher than the second time the sellers came in and stepped in over here and sent it lower. So let's see what happens. We have this that goes even higher and then it comes down and then you're like, what in the world is going on? This thing is just sitting here moving sideways, going higher, going lower, breaking this low, breaking this high. I'm so confused. Do I get in long? Do I get in short? Is this bullish? Is it bearish? Well, you got to sit back and look. Patience is the key to the game. Among a bunch of other things like discipline, patience, and many other factors. But we could see the diamond bottom form now. And why does it get this name is because, well, it's shaped like a diamond. The price action, the candles. Once you connect the dots, you start to see that, wait, this thing starts to look like a diamond. What is really going on over here? Now, it's not going to be a perfect diamond. Sometimes it might be a perfect diamond where it's like this, and the high and the low are basically connected if you draw a straight line down, but in this case, they're not. You can see the high is over here, and the low is all the way over here. So you'll see that a lot with diamond bottoms. The market is not a perfect place where things are perfect to what you want to see or what you want to happen. The market doesn't care about that. So let's take a look at this. The measured move we're going to expect for this diamond bottom is the highest point of the diamond up to the lowest point of the diamond. Again, we spoke about how it's not going to be a perfect line down because, well, we see it bottomed out over here and it topped out over here. But we drew the diamond out and we could see that it's clearly a diamond. It's not perfect, but it is a diamond. So we measure the move from the lowest point up to the highest point of the diamond. And where we're going to expect that move from is from the break of this resistance we have over here. This resistance where this is trending lower over here, where boom, rejected, rejected, rejected. Once we get that break above here, that's where we want to enter. So that's where the measured move is going to start from. Now, if it breaks out over here, okay, cool. We start the measured move from over here. If it breaks out over here, we start the measured move from over here. But what we know is that this over here is the measured move that we can add on once it breaks this resistance. Now, we get that candle that breaks above and closes above this trend resistance. That is what we want to see. Again, we want to see the break and the close above this resistance to make sure that the buyers are still in there. Within this, let's say this is an hour of time that's passing within this candle, we want to make sure that the buyers stay consistent enough to break it above this level of resistance where it was just having trouble breaking above. This trending resistance over here. Over here, it wicked above. We can see that it slightly wicked above it over here, but the sellers pushed it back down. So it's good to see it that it breaks, it clears, it closes above. Okay, maybe buyers are actually stepping up over here and keeping the price higher. Now, once you get that break, you see something like this. And once you see that break, we entered already. So we know if this thing goes back down, you need to cut the trade. You need to be able to get out the trade and accept that you were wrong. Accept that the market decides to change its mind. But if you get in over here and this happens, beautiful, boom, you ride the wave, bada bing, bada boom, you're happy. Now, a lot of times with this pattern, I noticed something where I'd spot this pattern, and when I spot it, it breaks above, and it breaks and maybe goes up here, and then it gets rejected and it sort of comes down back to this support over here. It comes down over here something and it holds and then it goes up. I noticed that a lot of times with this pattern. So you need to know your patterns, and you will know this time after time after time of seeing it happen, of experiencing it, of, okay, I got it on the break over here, but wait, this guy said that if it breaks over here, the measured move is this high, so I'm not getting out until it goes up here. That's not the right mentality to have because, okay, this guy said once you enter over here, it breaks. But this guy also said that any pattern in the market can go against you. Anything can happen at any given point in the market. So you need to stick with the idea that, okay, although people want to be right all the time, at the end of the day, if you're saying, oh, I'm comparing myself being right to the market being right, market doesn't care about you. The market cares about itself and itself only. And that's it. The market is always right. So let's say you do see a double bottom and then it goes like this. Okay, it went this way. The market is right. It went back down here. Why would you be right? If, okay, you assume the double bottom will come back to retest the neckline and go up. Okay, cool. That didn't happen. The market decided to go this way. Why? Because it wanted to. A lot of people sold. Something happened. So you need to understand that the market is always right, no matter what the case is. No matter how beautiful a setup can look, if you see a double bottom forming and over here buyers are stepping in, cool, it could come up here and then boom, it collapses. Why? Because the market is always right and the market does not care about you. As harsh as that sounds, that is the reality that you need to face. And in this industry, that is definitely something that you need to be able to deal with and understand that, okay, I will detach my emotions and understand that sometimes I will be wrong because the market will be right. I mean, all times the market will be right. Sometimes you'll be right, cool. But what happened with you is that you were able to take advantage of something that you knew there's a statistical probability that is in your favor. So over here, we know that, okay, cool, this broke above. From the past experiences of seeing diamond bottoms, this move happens and we get this move. But there's still the chance that this goes south. Why? Because the market is always right. The market doesn't care about you. So if you're able to enter over here on the break, and you know, okay, if it has this move, I get out over here. Cool. Let's say it does have this move. Over here, what are you going to do? You get out the trade, that's it. But let's say it does come back down over here, and you know, okay, let's say this is a $10 move, and this is a $2 move down. At this point, you're risking losing $2 to completely know that you're wrong, and the trade is going to go against, to make $10. So worst case, you lose $2. Best case, you make $10. And if you ask me, risk to reward wise, that's great. And we'll get more into risk to reward later on in the future videos. But I just wanted to brush up a little bit on certain patterns maybe going against, things like that. But this is the diamond bottom, how it goes. Again, let's take a quick recap. The stock comes from a downtrend and then forms this formation where it's a bottoming formation. And it's also shaped like a diamond in a way. Again, it's not going to be perfect, but it looks like a diamond. You get that break, close above this trend over here, you get in over there, you ride this wave, and then you get out. So that's all for this video. I hope you enjoyed it, and I hope to see you in the future videos where we talk about many other things that'll help you navigate through the market matrix.